The purpose of this video is to combine the concepts of market valuation and book valuation together with a company's capital structure to try to approximate what the best discount rate is. Oftentimes, when we've been doing our financial modeling, for example, when we did our valuations, we just assumed a 10% interest rate. Let's see how that calculation might actually work based off the weighted average cost of capital value. And then you have your D is on each case, E over V and D over V, for example, is going to rely on the market value of the company's both equities and debt. And then it's going to use those to prorate the expected return of equity and the expected return of debt, less tax, so that we get a portfolio view of what a group of investors would expect from a company's returns. So start off, we're provided with some information on the balance sheet. So for example, we see bonds payable of $5 million with $1,000 face value, 7.8% coupon, yielding semi-annual payments, maturing in 7 years and yields at 8%. So let's just go ahead and use, in a slightly different layout than normal, future value, payment, rate, and number of periods, because what we're going to need to solve for first is the current price of a bond. So we're going to work on this one first to begin with, based off of what we learned back in our Foundations of Finance. So we know if we have a $1,000 face value, that bond is going to be making payments to us. Those bonds have a coupon rate, as it suggests over here, of 0.785%. So that is going to determine the amount of our payment. But also those bonds are paying twice per year. So our payment is going to be future value or par value multiplied by the coupon rate, which gives us a 70, and that's our V. We get per year, but we need that to be semi-annual. We're going to have to take that and divide it by 2 so that we know now that our bonds actually pay $39.25, which then tells me my rate also needs to be semi-annual. And the rate that it's giving me is the yield to maturity of 8%. So let's do 8% divided by 2. And so now we have a 4% yield. And the number of periods then we know also need to be adjusted for semi-annual. And if the bond matures in 7 years with semi-annual payments, that means we've got 14 periods. So now that we have these labels and we know what our cash flows and rates look like, let's drop in our present value formula, where if the semi-annual rate is 4% and the bond matures in 7 years or 14 semi-annual periods, and then the payment is $39.25 per, and then I get 1,000 beginning, then the amount of my bonds cost would be $992.08 to a potential investor. Let's go ahead and switch the sign on that just so it shows up as our price of $992.08, and that would be our answer for part A. What is the current price of a bond? Now, if we want to get to B, though, what is the value of all the debt? Well, 5,000 is the book value of all the debt. But when you take into account the pricing, the market value is going to be a little bit different. So the first thing that we need to know is the number of bonds. Well, if you have $5 million worth of bonds, each with a face value of $1,000, what that tells you is that you actually have 5,000 bonds out there outstanding. So what that does is allows us to determine if I have 5,000 bonds, each of them cost $992.08. If an investor wanted to buy out all the bonds, then the market value of those bonds would be like $4.9 million, which is a slight discount below the book value shown because we have a discount on that price. So I've just truing these up, taken off the decimals. And now we would have for B, there would be the market value of our debt. So first we found the price, then number of bonds, and there's market value. Then we need to estimate then what is the expected return of the stocks? Well, we just got done covering that with CAPM, where we know then if we want to find the expected returns, then we need to have something like market returns, a risk-free rate, and a beta in there. So let's go ahead and notate the beta since it's buried within the problem standalone, 0.92. And then that would allow us to get our expected returns. And what I want you to notice is like here it's RE. And let's see, did I notate it as RE over here? I think I did it in a slightly different way. Yeah, RE. So it's just be careful with the differences in the way that the nomenclature works, because when we were doing CAPM over here, right, it's ERI, but they're all just expected return is what they're trying to tell you. So let's see if we can come up with the RE as we labeled it here, and that's going to be our answer for C, would be equals, we need the risk-free rate of return, plus we need our beta multiplied by our market rate minus our risk-free rate. And so there we know is our required rate of return that equity investors would want from us. 12.28% is what they would want. Whereas up here, we know that bondholders demand 4% semi-annually, or about 8% annually is their expectation. Now that we have that, let's figure out what the market value of our equity is. Well, that is similar to what we did up above with our bonds, where we need to know then what is the price of our stock. And the price is given to us at $23.99. And then same thing, we need to know the number of shares. So the number of shares is 500,000. And so the market value of that, or E, is the same as up above when we need to just go ahead and take price times quantity. So you have then as the market value of all of your equities just south of $12 million. So look at this here. This tells us capital structure. Here it was harder to determine capital structure because of the way we account for a penny par value versus 1,000 face value. So that's a struggle for us a little bit to figure out what our debt equity is just based off common stock here. Whereas now you can see we got about 12 million wrapped up here and about 5 million wrapped up here. So we're much stronger weighted in our equity. What that allows us to do is calculate the value market based of all of our outstanding securities. So you have your equity value and then you have your debt value. So our capital structure suggests that we have about $17 million in outstanding value in the marketplace. And that's our V. We can use then that to start to calculate the WACC if we notate each portion of this formula. So I'm going to notate it in order again in the bottom so that we can see how the math works. So we have E over V as our first term. That's basically the percentage allocation that equity is of our entire capital structure. So we see we are about 71-ish% equity driven. That equity then costs us, as we calculated above, we called it RE. Our investors expect 12.28%. So 70% of our capital structure investors want a 12% return. That's different than our D over V. This is the amount that our capital structure is allocated towards debt. So we have just under 5 million in debt divided by our 17 million in our total market value of our securities. So now if we highlight this and this, you see, right, 100% of our capital structure is coming from either equity or debt. So 29% is debt related. And if we look in the formula up above, it's then asking, well, what is that rate on debt? We didn't note it specifically in annualized terms because up above we had to do it semi-annually, but we were given that yields on debt are 8%. And then the last thing we need to have is a tax rate over here. And the tax rate was given to us in the problem as being equal to 25%. So these are all the components you need in order to be able to calculate the weighted average cost of capital. So let's go ahead and for part F, which is here, do that based off of what we found over here in part E and what we found over here in part D. Let's put it all together. So the formula suggests it's equals the percentage allocation of equity multiplied by the rate of return on equity, plus the percentage allocation in debt multiplied by the rate of return on the debt, multiplied by the tax shield provided by the debt from the interest expense. So multiplied by parentheses 1 minus the tax rate. And when we put that all together and expand the decimal, we can see that our final answer for the weighted average cost of capital is about 10.44% is what we would expect in total from our portfolio mentality for investors, 70% of whom are equity and demand 12-ish%, 30% of them who are demanding around 8%. And that's how you calculate the WACC.